And let's bring in Torsten Slok. He's partner and chief economist at Apollo. And Torsten, don't worry, we're not going to ask you to opine on any of the geopolitical stuff. Your job as an economist is to factor in all the costs that we see and establish a conclusion. Here's the reality about the price of oil. We think about the price of oil when it comes to gasoline, and that's true. About half of a barrel of oil goes into gasoline. But oil goes into a lot of things. Plastics, natural gas, by the way, goes into things like pharmaceuticals. This is, at least for now, somewhat inflationary. How do you believe the Federal Reserve and economists like yourself will look at what is happening right now? How do we model any of this?
Yeah, that's exactly right, Brian. So if you look at the Fed's own models for the U.S. economy purpose, if you simulate what does it mean when oil prices go up by $10 as they've done in the last 10 days, it will tell you that GDP growth will be 0.4% lower and inflation, exactly as you're highlighting, will be 0.4% higher. So that means that it is absolutely inflationary for the Fed going into next meeting. And this comes on the back of what we already are trying to deal with in the U.S. economy, namely tariffs are also inflationary. And on top of that, restrictions on immigration, as we saw in the employment report last Friday, are also inflationary. So it really is a set of shocks that are hitting the economy now that are putting upward pressure on inflation. And that's, of course, complicating the communication and the trajectory for the Fed next week.
Are you advocating for rate increases?
Well, this is the important discussion because it happens to be the case that all these three things, high oil prices, the tariffs, and also, of course, restrictions on immigration, they also lower GDP growth. If you raise oil prices by $10, obviously, we will all be buying marginally less gas and, of course, less energy. Likewise, tariffs, if prices go up, of course, you will also begin to see some downward pressure on sales and ultimately on GDP. And finally, also with the restrictions on immigration, that is also something that ultimately is a risk of slowing GDP growth. So the weird combination that the Fed is looking at the moment is a situation where you have inflation going up because of these shocks and GDP growth going down. So what will the Fed do when inflation goes up? The Fed should be hiking. If growth is slowing down, the Fed should be cutting. So which one is it? Does the Fed like apples? Do they like oranges? We're in the dual mandate. Will they put the weight? So far, they put a lot of weight on inflation, but we will have to wait and see next week what the communication is, because it's very clear that the Fed's forecast after what happened to oil prices today is that inflation will be higher than what they had in their original scenario.
Hey, Torsten, it's Dom. We had talked earlier about this idea that many traders are trying to handicap the situation right now, and this is a scenario that's developing where you have to kind of put scenario analyses in place, right? A certain set of circumstances happens. This is the expected outcome. As an economist, I use the word transitory. It's not a great word these days. We know that the Fed has made it maybe not the greatest word in the markets right now. But if you look at the price of oil and you look at the lack of real movement anywhere else within safe haven assets, if you're an economist trying to model out what the impact will be, can you make any kind of a real high confidence conclusion about whether or not this is going to be medium to longer term inflationary, or is this going to be, as it has in the past over the last 7 to 8 years, again, don't want to use the word, but I can't think of a better one, transitory in nature?
No, you're right, Dom. And as you talked about earlier, also, the overall market reaction here is very interesting, namely what's happening to dollar at the same time and what's happening to rates also going up at the same time. The challenge for the Fed is that they do have a meeting next Wednesday. So, yes, of course, if the shock is only temporary, if it only lasts, say, a few days, right, of course, it will be different in nature relative to if it lasts a longer time. But the answer to your question is that if there is indeed a meeting on Wednesday, the Fed will need in some way or another to incorporate this. And incorporating this will, adding to the other factors that are putting upward pressure on inflation, implying that we'll have higher inflation going forward.